Matthew Schlanger leads a group of accountants at Matthew P. Schlanger CPA here in Highlands Ranch, South Littleton.
Yep.
Very, very close to us, providing business and personal tax preparation as well as tax advisor services. Matthew's a native of Colorado, not very many of us.
Yeah.
He's a graduate of the University of Wyoming, and he's married with 2 children and is active at his parish at Park, Highlands Ranch. So without further ado, introduce Matthew Schlanger.
Thank you. Thanks, Carl. Thanks for having me. So we're just going to focus today on some tax updates. And if you have questions, we'll have time at the end. But most of our topics are going to be related to retirement taxation. And there will be some other topics related to savings, especially for your kids or grandkids' future. So to get started, one thing to remember is that in our tax system, any income that you earn can affect full tax systems at once, not only your federal income tax, which might be what you're thinking of, but there's also surcharges within your income tax. And it can affect your federal tax brackets, your capital gains tax, which comes after your ordinary income. Net investment income tax is a surcharge tax that you can have by when you reach a certain threshold, as well as IRMAA, which is what hurts a lot of people, which is your Medicare premiums that you pay once you're 65. And earning more money can make that pretty painful pretty quickly. So,
No kidding.
yeah. Retirement distributions can change your withholding needs and estimated taxes. So as you're pulling money out in your retirement, you do still have to make payments on that. Social Security, for instance, will withhold money for you, but it might not be adequate depending on whatever else is going on in your tax life, in which case you'd have to make estimated payments quarterly to avoid estimated tax penalties, which can also sneak up on you. And the planning window is always before year end. So if you were to come to me to help you with your tax planning on February 1st for this year, unfortunately, there's nothing I can do for you. But if you come to me in October, November, we can at least have a conversation about the things that you can change. So it's never at tax time. So please come early. The main pressure points we're going to talk to is the federal tax landscape, NIIT and Medicare tax more in depth, IRMAA. There are some big changes with charitable giving this year, which we're going to talk about, health savings account and health cost planning, some Colorado specific items to watch, and then family planning opportunities and a year-end checklist. So an update on tax brackets this year for 2026 ordinary income. It ranges from 12% up to $12,000. And this is taxable income, not adjusted gross income, up to $640,000 for 37% as single. Married filing jointly starts at 24.8 at 12% as your first brackets end, and then 768 up to 37% for married filing jointly. Things to keep in mind, these are income lanes, not gross income labels. So if you suddenly made $100,000 that as a married couple, that doesn't mean all of your income is taxed at 22%. Think of them like buckets. So you fill up your first bucket at 12% up to 24,800, and then you get to fill up the rest after that in the 22% bracket. So it's not it's not a flat tax system. It's a marginal tax system. And one thing to keep in mind from planning, especially as you work with Carl and his team, is in retirement, how are these tax brackets going to change if you're a surviving spouse? Because that's a big question in your tax planning. You might have a projection of what you're going to be this year, but next year, if you're a surviving spouse, that's a dramatically different conversation.
We got plans. We got plans on the table.
The standard deduction. The standard deduction is also pegged to inflation that the IRS releases every year. So these are the 2026 standard deductions that you have this year. You may or may not be taking the standard deduction. So back in the Tax Cuts and Jobs Act, when that was first passed in 2017, many more people significantly use the standard deduction rather than itemizing. However, with some changes in the SALT cap, which I'll get to in a second, as well as interest rates on mortgages are a little bit more expensive now, more and more people I'm seeing are itemizing again. So just keep in mind that your standard deduction comes into play if you are not itemizing. And you only itemize if it in total exceeds these standard deduction amounts. So as a married couple, that amount is $32,200. Single or married filing separately, it's $16,100. Now the SALT cap, which this is a change from last year, part of the Tax Cuts and Jobs Act is the state and local tax cap was $10,000, no matter how much state and local taxes that you paid, which basically is an effect to try to keep you from getting double taxed for tax you've already paid to the state. But that was something that was given up, part of Tax Cuts and Jobs Act. Now, as of last year, you can actually deduct up to $40,000. So those of you with high state and local taxes, you do get to deduct more and itemize. But that does phase out above 500,000 modified adjusted gross income, in which case it goes all the way back down to $10,000 at a certain point. But it never goes below 10. So depending on how much money you're making, if you're going to do any kind of distribution or rollovers out of, say, a 401k, try to switch to Roth, anything like that, just keep in mind that can affect your state and local tax cap. And again, the cost of an extra dollar of ordinary income only increases your tax on that dollar within that bracket. It's not all of your tax. That also includes Roth conversions, which I wanted to make sure that I brought up for you, because that's as you reach retirement or close to retirement, that's probably going to become a bigger conversation with Carl and his team. So you have to consider that marginal bracket that you're in for every dollar that you're converting, rather than all of your income as a whole hitting that 22% or 24%. And then also Colorado is a flat tax currently of 4.4%, which is on all income. So keep that in mind as well. Net investment income tax is where if you have a high enough income, you actually on your net investment income get a surcharge of 3.8%. So the thresholds on that are 250,000 for married couples, or 125 for married filing separately, 200,000 for single. So what that means is if you have capital gains in your portfolio, for instance, and you have more than 250,000 in income as a married couple, you are going to have an additional 3.8% on top of your capital gains tax. So that's just an extra tax a lot of people don't plan for. Capital gains, dividends, and interest all count. If you do have a rental property, passive rental income also does count for that tax. Any portfolio activity basically that is passive is subject to net investment income tax. Now, if it's active participation, that does not count. So if you are actively participating as a general partner in a partnership, for instance, that income on your K-1 is not subject to that tax. Another one is additional Medicare tax, which applies to anything that would otherwise be subject to Medicare wages. So if you are making more than $250,000 in that category, you then have 0.9% additional Medicare tax on all wages in excess. And that goes on forever. So not only are you paying the 1.45% that you normally pay as your half of Medicare, if you're self-employed, you're paying the 2.9, but then you also get the 0.9% on top of that when your Medicare goes above that $250,000 as a married couple. So depending on your income makeup, you could actually be hit with both net investment income tax and Medicare tax, in which case we want to make sure we're planning in a way for you to reduce both of those as much as we can, which might be taking advantage of certain benefits you have at your job, or if you're a business owner, certain things you can do within your business with tax planning and through retirement savings or HSAs and things like that to reduce your income to get you below or at least lower those dollar amounts you have in those categories. So IRMAA is a big one, which is the Medicare premium that you pay. So everyone pays Medicare out of their Social Security once they start drawing it. If you don't pay, or if you don't draw Social Security before you are on Medicare, then you're just paying your Medicare premiums out of pocket until you start drawing that Social Security. But the more you make, the more you pay. It's basically a means tested premium. And it's a 2-year income look back. So that means the tax return you filed just this year for 2025 is affecting your 2027 IRMAA. And it continues to go forward. So if you have a big income year this in 2025 and you start drawing Medicare or using Medicare in 2027, that's going to be a more expensive year. And you have to make sure you're planning for that. And you don't have there's a form you can fill out that says it was, there's a change in your lifestyle. Let's say you left your job or whatever it is. And that can be something we plan. But things like Roth conversions, for instance, do not qualify for that. So because you had control over it. So just keep in mind, if you're doing any kind of Roth conversions or any kind of distribution from retirement accounts, you will be subject to IRMAA that will not go away for a year. And here's an example of some of those just on how quickly it ramps up. This is the 2026 IRMAA brackets that are out there. So if your adjusted gross income for a joint couple is $218,000, you pay on your Part B premium $202 a month. But if you did, say, a rollover that got you into the $342,000 bracket as a married couple, you're suddenly paying $527 a month. So it gets very expensive very fast, and you have that for a full year. And Part D IRMAA might also apply, which is your prescription drugs. So then retirement income stacks effects across systems, as I kind of brought up before. So retirement income is normally ordinary income, in which case you're going to pay ordinary income tax rates. But then long-term capital gains brackets don't start counting until after we've accounted for all of your ordinary income. So you might not get any of that 0% bracket on long-term capital gains. You're automatically going to start in 15 or 20%, depending on where your ordinary income is. But then on top of that, if your ordinary income is high enough and then your long-term capital gains put you higher, you might have net investment income tax on top of that capital gain. So suddenly, instead of paying 15% on that capital gain, you're paying 18%. And then if you have enough income, not only did you pay that extra 3.8% for NIIT, well, now you've pushed yourself into an IRMAA bracket that made your Medicare go up in 2 years by another amount, in which case that doesn't go away. And then you have your Colorado flat tax income, which is 4.4% on all income. And then based on your income, you might have to make estimated tax payments in order to avoid penalties. And that's going to be based on a safe harbor from prior year or current year, which is 100% of prior year tax due or 110, depending on your income level, or 100%, 90% of current year tax due by January 15th. And those estimated due dates are April 15th for Q1, June 15th for Q2, September 15th for Q3, and then January 15th for Q4. And the remainder of your tax due is April 15th. So again, Roth conversions and portfolio gains should be viewed as part of the same income stack. If you're doing anything, it's going to affect all of those brackets, all of those different taxes. One thing I did not put down on here and I wanted to bring up as far as retirement income is the enhanced senior deduction for Social Security is still in effect. That was new last year, whereas you get $6,000 per person as an enhanced senior deduction on your Social Security income. So what that means is from a federal taxable income standpoint, you can reduce your Social Security income by up to $6,000 per person, as long as your adjusted gross income as a married couple is not over $150,000. After $150,000, it starts phasing out. For a single person, it's $75,000. A big one for planning is required minimum distributions. So generally, you're going to have to start withdrawing from your qualified accounts at 73 years old. And that is going to be based on the value in your account. And then the IRS puts out a table where you basically use that table and multiply it by the value, and that's how much you have to take out. If you don't take the money out that's required for an RMD, then they can charge you 50% of what you did not take out. That hurts a lot. Now, if you missed it, there are ways to ask for forgiveness. Say, sorry, IRS, we'll make it right. And we can do that. But if that happens, you recognize all 2 years of income in a row at once, in which case you're stuck with potentially all of these surcharges, which can really hurt. So do not miss your RMDs. Um, so all these questions you have to ask yourself as you're taking these RMDs and planning on it is it going to push you into another tax bracket? Is it going to push you to be subject to net investment income tax? Is it going to phase you out of Social Security deduction, the enhanced senior Social Security deduction? What is it going to do to my IRMAA? Because suddenly, once you have RMDs, you have no control anymore on your income. You have to take that money, which can push you into those higher brackets. And then we want to talk about is withholding sufficient on your RMDs and your Social Security combined, as well as maybe your portfolio income and the dividends you're receiving? Should you voluntarily withhold more from your IRA distributions, which I would recommend? So if you withhold through the IRA, for instance, rather than doing a quarterly estimated payment, you could withhold it all on the last distribution of the year, and it counts as if you made it for the full year. So it's timely. Whereas if you do it quarterly, and let's say you miss your quarterly estimated payment by a week or a month, the IRS automatically starts charging you failure to make estimated payment penalties. So you need to start making those on those due dates, which I already gave you, or withhold it all in the last distribution of the year, and it counts for the full year, and you don't have to worry about those estimated payment penalties. So the surviving spouse tax squeeze is real. Have this come up more often than you'd like to see. But you might have a tax plan and a financial plan that makes sense until your spouse passes, in which case your taxes get a whole lot more expensive. Now, one thing to keep in mind is the year that your spouse passes, you are still considered married and filing jointly until the end of that year. And if you are a qualified surviving spouse, meaning that you have kids or dependents at home, you still get 2 years while you still have dependents beyond that. But if you are otherwise empty nesters, after that first year, then you have just that year for married filing jointly. And after that, you're single again, and your tax brackets get smaller, the thresholds get lower, and you're paying a whole lot more money into IRMAA, for instance. This is a big one that starts this year as charitable giving has new rules. So itemized deductions is where this comes up typically. Normally, all of your charitable giving, if you itemize, counted. Well, starting this year, charitable giving has a floor based on your adjusted gross income of 0.5% before it starts counting. So if you make $100,000 as adjusted gross income, your charitables don't start until $500. After that, they start counting. So the more money you make, the more it's going to take cost to actually get benefit from charitable giving, which is strange because normally you want to, as a policy perspective, encourage charitable giving, which this seems to not do. So just keep that in mind when you're doing your donation planning for this year. Now, if you're not itemizing, one thing that does benefit charitable giving is there is the above the line deduction starting this year, up to $1,000 for single or $2,000 for married filing jointly, where your donations, if you're not itemizing, will still count up to potentially $2,000 in a year. So that's a benefit, at least. So one thing because of that, like let's say you have a really great income year for whatever reason, is you might want to bunch charitable giving, in which case you say donate 5 years worth of donations all at once. And you might say, well, I don't really want to give this charity or my church or whatever it is 5 years of donations at once. They might not know what to do with it. I might not even want to do that much. So there's something called a donor advised fund that you can use where you can put all of your money, your donations for however many years that you're budgeting into that donor advised fund. And you get credit for your donation to that donor advised fund all at the point of contribution. And then from there, that money typically can either just sit in cash or be invested. And that would be something you'd want to talk with Carl about. But from there, you get to tell the donor advised fund when and how much to give to the different charitable causes that you have. So that way, you're not just going to that charity and saying, here's 5 years, hope you use it well. You put the 5 years put into that donor advised fund and piecemeal it out over time. And that way, we're not as worried about that 0.5% floor because you're putting all that money in there right away. And then from there on out, maybe you just put $2,000 a year to charity when you're not itemizing, for instance, because you've done this year in the donor advised fund, and then you get that $2,000 deduction above the line in those subsequent years. So that could be a good strategy to bypass that 0.5% floor. Now, when you're retired and you're taking RMDs, one thing to consider is the qualified charitable distribution, which is a different problem we're trying to solve than the 0.5% floor in donor advised funds. So when you're taking those required minimum distributions, what you can do is you can say, I want $10,000 that I really don't need to go to the charity of my choice directly from your IRA. And in which case that you never receive that money, it counts as your RMD, and it doesn't hit your adjusted gross income. So it helps you avoid things like the IRMAA surcharges. It helps you avoid net investment income tax. It doesn't affect your gross income, which is great. But you have to be charitably minded. It doesn't make sense if you're not charitably minded. But that is something that you can do to avoid some of those taxes. And qualified charitable distributions can be very powerful once you're on RMDs. So a fun one, if you have a high deductible health plan that qualifies, is HSAs. This is something that you can do, a health savings account. So you can put money in tax-free. It's one of the only triple tax advantage things Congress ever did, which is amazing. So it goes in tax-free, grows tax-free, and comes out tax-free, as long as you use it for qualified medical expense. The fun thing is, though, you can put money in tax-free today. You can save your receipt today, for instance, for a medical bill you have. Let it grow invested in your HSA, and in 20 years, use that receipt from today to pull out that money. So you get all that compound growth and the benefit of invested health savings account to grow, a balance to grow. So that's a fun little thing you can do. And the other part is, if let's say you're the healthiest person in the world and you don't need anything for healthcare costs in retirement, it can convert effectively into a traditional IRA, and you just pull it out and take the money out and pay income tax. So with no penalty. Now, one planning point to keep in mind, though, is it can also just be used for future healthcare costs, even though you're no longer in a qualified HSA plan for health insurance. So you can let it grow, and then in retirement to reimburse yourself, say, for Medicare premiums, or to reimburse yourself for out-of-pocket costs. You don't have to be in a qualifying high deductible health plan to still use that money. So it's still very powerful in retirement for health savings. So this year, the limit for a family is $8,750. Next year in 2027 is already marked for inflation up to $9,000. And there is the over 55 catch up of $1,000. So you can potentially do $9,750 or $10,000 in a year. Now, I talked about letting it grow, and it can be very powerful in that regard, but there is a trap. Is if you pass away and there's still a balance in that HSA. So if you have a surviving spouse, it can generally go to your surviving spouse and be treated as theirs, and there's no tax consequence. But if you are the only person left and it was to go to your kids or your heirs or whoever that is, it is fully taxable in the year of your death. So if there is $100,000 in that HSA and it goes to your child, they are going to have to withdraw and pay tax on $100,000. It's not like the IRA rules where you get to spread that out over 10 years. It's all at once. So just keeping that in mind, do not overfund it if you don't think you can use it in retirement. You'll want to talk to an attorney about that, but I would generally say no. So, yeah. So Colorado, as you know, currently has a 4.4% flat tax on all income, but there are some reductions from retirement income within Colorado. So pension and annuity subtractions do exist up to $24,000, for instance, once you're over 55. Beyond that, it's no longer deductible after the 24,000. Under 55, it's not deductible at all. Social Security over 65, 65, not 55. Colorado also has specific Social Security subtractions where you get to subtract out Social Security income once you also reach the 65-year-old threshold. Below that, it's a lower amount that you can deduct. Under 55, you can't do it at all if you're on SSDI, for instance. And joint filers need to compute the subtraction separately. So if one person is above the age threshold, they can get the deduction, but not the other spouse. So just keep that in mind. There's a couple of items for Colorado specifically that I wanted to point out. One of them isn't even income tax, but it's tax that we all pay. Anyone who has a software subscription, beginning January 1st, 2027, Colorado has repealed the download software exemption for software transactions, which means you're going to start paying sales tax in Colorado on any of your software, which has not been the case before. So that's an additional 2.9% on your Netflix subscription. That's an additional 2.9% on your Microsoft Office, all of it. So Colorado did repeal that. And then we are a home rule state, which means wherever you live or wherever you have that product delivered, your local jurisdiction can charge an additional sales tax on top of that 2.9%. So my office is in Littleton already. Littleton actually hasn't conformed to this in a long time. So I already pay sales tax on my software. And now I'll have Colorado. I'll be at about 7% sales tax on my software starting next year.
That's thanks.
Yeah. So things are just getting more expensive. Yeah. Another one to keep in mind and keep an eye out for is Initiative 195, which is gaining steam. Don't know that it's going to pass, but something to keep an eye out is it is a proposed graduated income tax structure in Colorado, which means progressive taxes in Colorado. If this does pass, it will likely hit a ballot, if not this year, maybe in 2 years, it'll be on the ballot. It is something that they've been fighting for a while. So just for a long-term tax planning perspective, if you're going to live in Colorado in retirement, is you could potentially be paying up to 8.4% tax at certain income levels if this does pass. It is not settled law, but it is a watch item. Just keep an eye out for that for your long-term tax planning in the state. So one new planning tool that did come out this year that I did want to bring up is the Trump account, or a 530A account. Is a new savings account that came out for kids this year, and it might be powerful depending on your specific circumstances. I only recommend it to people who have a lot of extra money to save because there's other tools out there. But the one nice thing is you can give $5,000 in a year to a child, anyone under 18. And that $5,000 is not tax deductible, but it does grow tax free. So it's like a traditional IRA in effect. And in fact, when the child turns 18, it becomes a traditional IRA. The nice thing is it does not have an earned income requirement. So right now, if my child was working, I could give them $6,000 to put in their IRA as long as they've earned $6,000. But with the Trump account, they don't have to have a job. So you could have a 2-year-old and you could put $5,000 into their Trump account. And it is growing tax-free and is an IRA once they're 18. The thing is, it is their money once you contribute the money to that account. There is no getting it back. Also, depending on your investment philosophies, you could talk to Carl about, but it's only in broad market indexes in the United States stocks only. It cannot be invested any other way. You have no control over it. Now, keep in mind that it does have an effect on annual and lifetime exclusions, potentially for gifts. So you can give $19,000 per year per person, but the $5,000 to this does count against that $19,000. And that you can give more than 19, but 19 just means that's before you have to do any kind of paperwork. After 19,000, you have to do some paperwork. And then if you have an estate over the lifetime exclusion limit, then that could go against that lifetime exclusion. But we're talking in the tens of millions of dollars at that point, in which case that's your problem then. And as long as you're comfortable with your child having that money until they're 18, then it can be a very powerful tool. And then one other thing is a Roth conversion when your kids are 18, which makes this even more powerful. So there's a couple aspects to that where you want to plan right away if you are going to do this, because it's a non-deductible contribution. So you have to track basis, which means your contributions on this every year until that child's 18 for however much you give, because that basis you're not going to pay tax on when you convert it to Roth when they are 18, only on the gains. So you could potentially have a really nice Roth IRA for your kids when they're 18 without having any earned income, which really powerful. The other thing is if you have a child or a grandchild born this year or the next 2 years, the federal government is giving a $1,000 grant. So even if you're not going to use it otherwise, sign up and get the $1,000 for the kids born this year and the next 2 years. The other thing right now is Dell, the company, depending on your zip code you live in or your child or grandchild lives in, they are doing a $250 grant into these accounts based on the average income of your zip code. So, and that's up to $25 million, I want to say. So that is, take the money if you can get it. The best planning can happen when all of our advisors can coordinate. So it's best if when we're working together on your tax plan, if we can also sit down with your financial advisor, because what they're telling you will affect your taxes. What I'm telling you will affect your financial plan, but they can't live in silos, because I might talk to a business owner I say, you know, let's save this amount of money to save you taxes in a 401k or whatever it is, but that may or may not fit your overall financial plan. I'm just going to tell you what makes sense for you from a tax savings perspective, because that's my lane. So when we can all sit together and talk together, that's when your relationship with your accountant and your financial advisor are most powerful. So I just recommend anytime you're going to have a decision to be made, invite both of us to the room. So before the end of the year, if you're worried about any of these taxes or anything I brought up today, here's a checklist for you to be concerned about, which is project your ordinary income and your taxable income, especially if something like RMDs are going to start this year, or you are going to start drawing on your IRA. Check your capital gains and losses and net investment income tax exposure if you've made any trades in your account. Model Roth conversions before executing. Review your IRMAA sensitive income thresholds. You know, whatever you do this year, if you're going to start getting Medicare in 2 years, this year matters a lot. Revisit your itemizing and charitable bunching and qualified charitable distributions. Confirm your HSA eligibility limits and the beneficiaries on that account. You don't want it to go to someone who's going to get hit with a tax bill right away. Check your Colorado specific treatment on different taxable items, and then update your withholding or your estimates. And we can help you with all of that. If you want a second set of eyes on your tax picture, feel free to go to my website, cpaschlanger.com. You can click on set an appointment and you can put yourself on my calendar right away. I also have my business cards for those of you here, and you're welcome to take some. But does anyone have any questions?